Welcome to the Pro Ticker Deep Dive.
It's really good to be here today.
And wow, what a week.
Yeah, that is an understatement.
Usually when we sit down to do these deep dives, there's maybe, one big story dominating the cycle.
Right, like a massive IPO
Or an election or something.
Yeah.
Yes.
Exactly.
But this week,
It's just noise everywhere.
if you are looking for a boring, sleepy week in the markets to just sort of coast through,
This was definitely not it.
not even close.
No, it's one of those weeks where you wake up and you check the terminal
Yep.
and you just feel like the ground has shifted under your feet overnight.
It really does.
Yep.
So just to set the scene for everyone listening, it is Thursday, February 26, 2026.
A date for the history books, maybe.
Truly.
Mm.
And I feel like the market is trying to digest an entire year's worth of news in about 48 hours.
It's heavy.
It's so dense.
Incredibly dense. Just think about the cross currents we are seeing right now.
Oh, absolutely.
You have the biggest company in the world reporting earnings that technically beat expectations.
Right.
But they still triggered a massive sell-off.
Which we will get into.
And then you have these huge geopolitical shifts with the U.S.-Iran nuclear talks in Geneva.
Right in the middle of all of this.
Right. And tariff confusion coming out of the White House.
Yep.
And then right in the center of it all, you have arguably the most significant structural shift in the software industry.
Since the cloud.
Since the invention of the cloud, exactly. It's just a lot of noise.
It feels like we're standing at a crossroads today.
Mm-hmm.
A lot of investors I talk to are feeling a bit of whiplash.
Oh, for sure.
They don't know if they should be popping champagne because of the tech earnings
Or buying canned goods because of the geopolitical tension.
Exactly. So our mission for this deep dive is to try and cut through that noise for you.
Because there's a lot to process.
So much. We have a massive stack of material here. We've got earnings transcripts from the biggest tech giants.
Analyst notes from all the major banks.
Macro data sheets, all of it.
Yeah.
And we're going to try to connect the dots.
And the question we really need to answer today, the thread that ties all of this together is this. Are we just in a massive bubble that is finally starting to spring a leak?
Or are we transitioning into the messy, complicated, expensive, but very real deployment phase of AI?
Because the hype phase is easy.
Oh yeah, hype is cheap.
Right, but the deployment phase is hard work.
So we've got three big themes to unpack to answer that today. First up, the AI hardware reality check.
Crucial.
Talking about NVIDIA, obviously.
Okay, guys.
But also a massive challenger entering the ring with a $100 billion price tag.
Which completely changes the monopoly board.
It really does.
It fundamentally shifts the supply chain dynamics for the next 5 years.
And then second, we have something called the SaaS apocalypse and the rise of agents.
This is the one that's a little terrifying.
It is. It's fascinating, but frankly terrifying if you work in that sector.
Yeah.
It's about Salesforce. It's about Anthropic's Claude.
And the end of the selling seats to humans business model.
Right. That structural shift you mentioned.
It changes everything about how software companies make money.
And how they justify those crazy valuations.
Exactly.
And third, the macro backdrop. Because while all this tech stuff is happening,
the real world is still turning.
Unfortunately, yes.
Yeah.
We have treasury yields dropping. We have tariff threats flying around.
And labor data that is looking a little soft.
Right.
The real economy is knocking on the door. You can't ignore the cost of capital and the geopolitical risk.
No matter how good the AI chips are.
Right.
So let's dive right in. Segment 1, the NVIDIA paradox. Or, as I've been calling it in my notes, the King's Dilemma.
It is a paradox, isn't it?
It really is. So let's look at the numbers. NVIDIA releases their fiscal Q4 2026 results.
Right.
The entire market was holding its breath.
The whole world was holding its breath.
And by any normal standard, they completely crushed it.
Absolutely. If this were any other company in any other sector, the stock would be up 20%.
Easy. Earnings per share came in at $1.62.
Right.
And the expectation was $1.52.
So a huge beat.
A massive 10-cent beat. Revenue is through the roof.
Yeah.
Margins are incredibly healthy.
Analysts are literally calling it the largest, cleanest beat ever.
And yet what happens?
The stock drops.
It drops significantly, down roughly 4.7 to 4.9%.
It's that classic sell the news reaction.
Right. But I think for the listener,
Yeah.
they need to understand that there is more nuance to it than just traders clicking a sell button.
Oh, absolutely.
Because if I'm a listener holding NVIDIA stock or just watching from the sidelines, I'm scratching my head.
Yeah.
I win, but I lose. Why does that happen?
Well, first you have to look at market psychology, right?
Okay.
When a company is priced for perfection.
Which NVIDIA definitely is.
Exactly. Perfection is just the baseline.
Right. It's the bare minimum.
It's the minimum requirement to keep the stock flat. The market was already pricing in a massive beat. Everyone knew the numbers would be good.
So it wasn't a surprise.
Right. So when they got the confirmation, the sophisticated money, the hedge funds, the algos,
They took their profits.
they took their profits and rotated out. That's the short-term mechanic.
Buy the rumors, sell the fact.
Exactly.
But there's a deeper anxiety here too, isn't there? It's not just about a quick trade. It's about the cash.
That is the key structural issue, yes.
Let's unpack that.
So investors are starting to ask very loud questions about cash returns.
Because NVIDIA is generating just an absolute ocean of free cash flow.
Right, and Wall Street, being Wall Street, wants to know, when do we get it?
Where is our cut?
Exactly. They want dividends. They want massive stock buybacks.
They want the check in the mail, basically.
They want that cash returned to shareholders. But NVIDIA is doing something else.
What are they doing?
They are pouring that cash right back into R&D, into supply chains.
Building more factories.
Securing manufacturing capacity. They're building this massive infrastructure.
So they're spending aggressively to stay ahead.
Right, and there is a tension there between investors who want a payout right now and a company that says, no, we are still building the future.
It's almost like the investors are saying, okay, you won the race, give us the prize money.
Yeah.
And NVIDIA is saying the race isn't over, we're buying a faster car.
That is a perfect analogy. And they have to buy a faster car because everyone else is trying to build one too.
Exactly.
But speaking of that faster car, we have to talk about what CEO Jensen Huang said on the earnings call.
Oh, yes.
Because he dropped a phrase that I think defines the next 2 years of this entire industry.
I know exactly the one you mean.
Yeah.
Inference equals revenue.
Inference equals revenue.
Okay, I want to pause here.
Sure.
Because we hear these terms thrown around constantly. Training versus inference.
Right.
And for the non-technical listener, and frankly for me, because it gets confusing really fast.
It does.
Let's break that down. What is the actual difference, and why does inference equals revenue matter so much right now?
Okay, think of training as sending a kid to medical school. It is incredibly expensive. It takes a long time.
Years.
Right? You are pouring resources, books, tuition, energy into creating this intelligence.
So that's what the last 3 years have been.
Exactly. Companies buying ships to train their models.
It's a sunk cost.
It is. You are spending money to build the brain.
Got it. So training is the education phase. Huge investment, zero immediate output.
Correct. Now, inference.
Yeah, what's inference?
Inference is the doctor actually working.
Ah,
It's when the doctor performs a surgery and bills the patient.
makes sense.
It's when you ask an AI model a question and it gives you an answer. It's when the model is applied to do actual work.
So when Jensen says inference equals revenue,
He is telling the market, our customers aren't just building these models for fun anymore.
they're turning them on.
They are turning them on, and they are making money every single time someone uses them.
So we are officially moving from the building phase to the money-making phase.
That's the hope. And it's crucial because the bears out there, the skeptics,
Right.
they've been saying, look at all this spending on chips, hundreds of billions of dollars. Where is the ROI?
Where's the profit?
Exactly. Jensen is trying to pivot that narrative. He is saying the ROI is here right now. The inference engines are running.
That's a massive shift in tone.
It is.
He also talked a lot about sovereign AI.
Yes.
This idea that nations, not just companies, but actual countries, are building their own AI infrastructure.
This is a huge growth vector that I think a lot of retail investors just completely miss.
How so?
Well, countries like Japan, Canada, France, Saudi Arabia,
Right.
they do not want their national data, their cultural history, their government secrets residing solely in U.S. hyperscalers.
Like Microsoft or Google.
Exactly.
They don't want to rent their intelligence from an American landlord.
Precisely. They want sovereign clouds.
Sovereign clouds.
They want to own their cultural and linguistic data and process it entirely within their own borders.
For security.
Yes. So they are buying massive clusters of NVIDIA chips to build national AI infrastructure.
It's a matter of national security for them at this point.
It really is.
It's almost like treating compute power as a natural resource,
That's a great way to put it.
like oil reserves or fresh water. You need your own supply, or you're vulnerable to whoever have it.
That is exactly how these nations view it. It is strategic infrastructure.
Wow.
And the thing is that demand is very sticky.
What do you mean by sticky?
I mean, a government doesn't just turn off a national infrastructure project because interest rates ticked up a quarter point.
Right. They're committed for a decade.
Exactly. It provides a very solid floor for NVIDIA's demand.
Now, we can't talk about NVIDIA without talking about the hardware itself, the Blackwell chips.
Right. The new standard.
These are the absolute beasts of the industry right now.
Unmatched performance.
But there was an interesting, almost throwaway note in the reports about where these chips are actually ending up.
Yes.
There's a specific mention of Inner Mongolia and restrictions regarding China. What is the tension there?
This is the geopolitical tightrope that NVIDIA walks every single day. Like, the U.S. government is very, very strict about what chips can go to China.
Because of military concerns.
Exactly. They are terrified of advanced AI being used for military applications or cyber warfare. We saw those restrictions impacting DeepSeek recently.
Right, right. So NVIDIA has the best product in the world.
But they aren't allowed to sell it to one of the biggest markets in the world.
Not the top tier stuff anyway.
No, definitely not. The report suggests that while NVIDIA dominates globally, the Blackwell clusters are being carefully monitored.
So where are they going?
They are likely clustered in data centers where U.S. oversight is possible, or they're just being restricted entirely from certain regions.
So it creates a ceiling on their growth in Asia, effectively.
Effectively, yes.
So even though they had this monster earnings beat,
Yeah.
they have this constant regulatory cloud hanging over them.
Always. You just can't decouple NVIDIA from U.S. foreign policy anymore. They are tied together.
Fascinating. And there's another metric Jensen focused on that I want to bring up. Performance per watt.
Yes, this is absolutely critical.
Usually when we talk tech specs, we talk about speed, right?
Right.
Gigahertz, teraflops, parameter counts. Why are we suddenly talking about watts? Why is the electricity bill the headline feature?
Because we're hitting a hard physical wall.
Power.
Power. Data centers are consuming massive amounts of
I
electricity.
see some crazy stats on this.
In some regions, they're consuming as much power as a small city.
Just a warehouse full of computers.
Yes. And if you make a chip that is twice as fast but uses 3 times the power...
Nobody can install it.
Right, because the local utility company literally cannot supply the electricity.
You literally trip the breaker for the entire town.
You melt the wires. You crash the grid.
Wow.
So performance per watt is the new efficiency metric.
Yeah.
NVIDIA isn't just selling speed anymore, they're selling energy efficiency.
So what's their argument with Blackwell?
They are arguing that by upgrading to Blackwell, you actually save money on electricity in the long run.
Because it does the math faster for less power.
Exactly. You get more intelligent for every electron you burn.
It's almost like the green argument for AI.
Which is deeply ironic considering the overall consumption.
Very ironic. But I get the economics of it. If you can't plug it in, you can't use it.
Right. It's the only way the scaling continues. Without efficiency, the entire AI boom hits an energy wall and stops cold.
Okay, so NVIDIA is still the king. They beat the numbers. They have the roadmap. They have the sovereign AI narrative driving demand.
Yep.
But the Kessel walls aren't quite as impenetrable as they used to be.
No, they are not.
Which brings us nicely to segment 2. The challenger arrives.
The $100 billion bet.
This news dropped like an absolute bomb this week.
It did.
Meta Platforms, so Mark Zuckerberg's empire,
Right.
has inked a massive deal with AMD.
It is massive. It changes the conversation completely.
The valuation of the deal is being cited at $100 billion for GPUs and AI hardware.
Which is just a staggering number.
And the specs mention 6 gigawatt graphics processing units, deploying starting in the second half of 2026.
I want to contextualize that number for a second, if I can.
Please do. 6 gigawatts. What does that actually mean? Is that a lot?
It is an immense amount of power.
Okay.
To put it in perspective, a large nuclear power plant might produce 1 gigawatt. One. We are talking about 6 gigawatts of capacity.
That's 6 nuclear power plants.
Yes. That represents a deployment scale that rivals major utility grids. This isn't just buying a few extra servers for a data center. This is building an entirely new industrial base.
So talk to me about the narrative shift here.
Yeah.
Because for years, the story has been NVIDIA is the only game in town.
Right.
If you want to do serious AI, you buy Team Green, you buy NVIDIA.
Yeah.
And if you try to buy anything else, you're just buying second-rate gear.
That was the perception, yes.
But now Zuckerberg is buying red. He's going with AMD. Why?
It's about leverage and diversification.
Simple as that.
Pretty much. If you are Meta and you are planning to spend tens of billions of dollars on compute every single year.
To train Llama and all their models.
Right, to train Llama and power your recommendation engines, you cannot be beholden to a single supplier.
Right.
You just can't. It gives that supplier NVIDIA way too much pricing power.
It's business 101, really.
Yeah.
You don't want a monopoly controlling your entire supply chain.
Exactly. You want vendors fighting for your business.
So by signing this massive deal with AMD, Zuckerberg is doing what?
He's doing two things. One, he is securing a secondary supply of chips so he doesn't have to wait in line for NVIDIA.
Because the wait list is long.
Very long. He ensures he actually has the hardware he needs to build his models.
And two,
He is signaling to the market, and specifically to NVIDIA, that there is an alternative. It forces price competition.
it effectively crowns a new king, or at least a prince, in the AI hardware space. AMD is finally a real structural threat.
They are. And more than that, this validates AMD's technology entirely.
How so?
For a long time, the knock on AMD was great hardware, bad software.
Right. ROCM versus CA.
Exactly. But if Meta, which has some of the most sophisticated AI software engineers in the world.
Yeah, they know what they're doing.
Right. If Meta says AMD chips are good enough for us, that is the ultimate seal of approval.
It tells every other CTO out there, if Zuck can use AMD, maybe we can too.
Exactly. It opens the floodgates.
But Wall Street seems surprisingly split on this.
Very split.
I was looking at the analyst reactions before we started recording. Bank of America is bullish. They see the long-term earnings upside for AMD.
Right.
But JP Morgan and Goldman Sachs are, let's say, a lot more cautious.
They are very skeptical of the CapEx.
The spending,
Yes. They are looking at that $100 billion price tag.
which is huge.
$100 billion is a staggering amount of money. The skeptics are asking, do you really need this much compute?
Is it too much?
Is this a capital arms race that just completely destroys profitability across the board?
They worry Meta is overbuilding.
Exactly.
It feels very much like the dot-com era fiber optic build-out.
Oh, that's a perfect comparison.
I remember reading about how telecom companies laid miles and miles of dark fiber across the ocean bottom
Right.
that nobody used for like 10 years because they anticipated web traffic that just didn't show up yet.
That is exactly the fear here,
Yeah.
that we are building dark fiber, but for AI chips.
Dark silicon.
Dark silicon, yes. The bears think these chips will just sit idle in a data center.
But the bulls.
The bulls and Zuckerberg, obviously, they argue that demand is exponential.
Right.
They believe that if you don't build the capacity right now, you won't be able to compete when the models get 100 times smarter next year.
It's a build or die mentality.
It really is.
It's a high-stakes poker game. And it seems like the deployment phase we talked about earlier isn't just about the hardware.
No, it's about software, too.
It's about who is actually doing the work.
Mhm.
Which brings us to segment 3.
The big one.
And honestly, this is the part of the deep dive that genuinely gave me the chills when I was researching it.
The sauce apocalypse.
The sauce apocalypse. I mean, it sounds like a bad sci-fi movie. But the economic implications are very real and happening right now. Let's define sauce for everyone first, just so we're all on the same page.
Sure. Software as a service.
Right.
The dominant business model of the last 20 years in tech.
Think of Salesforce, Zoom, Slack, HubSpot.
Exactly. And the model is very simple. You are a company. You hire 100 salespeople.
Okay.
You buy 100 seats of Salesforce.
Right. I pay a monthly fee per head.
The per-seat model, yes. Your software revenue scales linearly with the number of humans your customer hires.
So it's essentially a bet on corporate headcount growth.
Exactly.
Okay. And now we enter the agentic era. We have AI agents.
And that fundamentally breaks the model.
We have to talk about this Claude Cowork example because it is just mind-blowing.
It really is.
This is from the source material regarding Anthropic's new plugin.
Yes, the Rakuten case study.
Rakuten, right. So they plug this AI agent Claude into their engineering workflow.
Right.
And in a single day, this thing didn't just chat.
No.
It didn't just summarize a meeting for them.
It did actual work.
It closed 13 engineering tickets.
And let's be very specific about what closed means in this context.
Yes.
It didn't just say, hey, here's an idea for a fix to the code.
Right. It wasn't just advice.
No, it wrote the code.
Mm.
It ran the unit tests to make sure the code didn't break anything else in the system.
Wow.
It debugged its own errors when it found them. And then it actually pushed the code to production.
They did the job.
It did the job of a junior software engineer start to finish.
And then the report says it reassigned 12 other tickets to the right humans Because it knew who was best at what task.
Correct. So it acted as a project manager and a developer simultaneously.
So let's just do the math on that.
Yeah.
If I'm Rakuten
Yeah.
and I have an AI that can do the work of, say, 5 junior developers,
Right.
do I hire those 5 junior developers?
You do not. Or at least you certainly don't hire them to do that specific work.
And if I don't hire them, I don't buy 5 seats of software for them.
Exactly.
I don't buy 5 Salesforce licenses. I don't buy 5 Slack accounts.
And that right there is the apocalypse.
Because the headcount goes down.
Right. If you are a software company whose entire multi-billion-dollar valuation is based on selling seats to humans,
Yep.
and your customers are actively replacing humans with agents,
Your revenue goes to zero.
it evaporates. The fundamental unit of value, the human seat, is disappearing.
Unless you pivot.
Unless you pivot and sell the agent instead.
Which brings us back to Salesforce.
Mm.
We've been watching Salesforce for years.
Yep.
And Mark Benioff, the CEO, I mean, the guy knows how to pivot.
He is the ultimate survivor in this industry.
He really is. So they just reported their Q4 2026 earnings. They beat expectations. The stock is up about 3.8%.
Good solid quarter.
But the story isn't really the beat, is it?
No, the story is Agentforce.
Agentforce.
Benioff is aggressively rebranding the entire company around this concept.
Because he sees the threat.
He sees the writing on the wall better than almost anyone. He knows the seat model is dying, so he is pushing Agentforce and this other thing called Data 360.
And the numbers for those are pretty impressive.
Very.
Agentforce and Data 360 ARR, so annual recurring revenue, is over $2.9 billion.
That's up 200% year over year.
That is hyper growth inside a mature legacy company.
That is startup level growth at a giant enterprise scale. It's incredibly hard to do.
And here is the key insight that Benioff is pitching right.
Yeah.
The AI is only as good as the data it has access to.
This is the crux of their whole argument.
If you hire a generic AI agent from OpenAI or wherever,
Right.
it doesn't know your specific customers.
It doesn't know your sales history. It doesn't know your pricing negotiation tactics.
But Salesforce has all that data.
Exactly. So Benioff argues our agents are better because they live inside your proprietary data.
Right. He claimed on the call that Salesforce is, quote unquote, 10 times more valuable because of this data.
It's the moat.
The moat, right.
In an AI world, algorithms are quickly becoming commodities.
Everyone has access to a smart model now.
Right. Data is the moat. Context is king.
They highlighted a trilogy of customers on the earnings call to prove this.
Yeah, Wyndham Hotels, Shark Ninja, and Soster.
The Soster one was really interesting to me.
Very much so.
Because Jason Lemkin runs Soster right.
Yes.
And he's kind of like the godfather of sauce.
Yeah.
If you work in software, you know his name.
Oh, absolutely.
He was on the earnings call, and he said something that I think sums up the entire industry mood perfectly right now.
What did he say?
He said, if you're not excited to be building in an agentic age, you should quit.
It's a stark warning.
Very.
Adapt or die, basically.
He also mentioned that the companies winning right now are the ones moving to outcome-based pricing.
Yes. This is the solution to the seat problem.
Explain that for me. How does outcome-based pricing work?
Okay, so instead of charging $50 a month for a user to just log in,
Right.
you charge $5 per customer service ticket actually closed.
Okay.
You charge $10 per qualified sales lead generated by the agent.
So you charge for the work the agent actually does.
You charge for the outcome, not for the access to the tool.
That shifts a ton of risk onto the software company, though, doesn't it?
It does.
I mean, the software has to actually work.
It forces accountability.
Mm.
If your AI agent is bad, you make no money.
Right.
But if it's good, you make essentially infinite money because it scales instantly. It completely decouples revenue from corporate headcount.
It's a brave new world for software sales.
It really is.
So we've got the chip wars, we've got the software revolution with agents.
Yep.
But none of this happens without the actual factories.
The physical reality of it.
Exactly. Which brings us to segment 4, the hardware backbone.
TSMC.
Taiwan's semiconductor manufacturing company.
Probably the most important company in the world that most people don't think about on a daily basis.
Truly. They make the chips for NVIDIA.
They make the chips for AMD.
They make the chips for Apple.
They are the global foundry.
They are the bottleneck and the enabler all at once.
Every dream, Zuckerberg or Benioff has it all physically runs through a TSMC fab.
So TSMC gave their guidance this week.
Right.
Revenue beat expectations as expected. But the absolute jaw-dropper is the CapEx, the capital expenditure.
Unbelievable numbers.
They are spending $54 billion in 2026 to build more capacity.
54 billion.
That's up from $41 billion in 2025.
Let me just say, you do not spend $54 billion on a hunch.
No, you do not. That is not. Let's see if this whole AI thing works out kind of money.
Not at all. That is concrete and steel. That is clean rooms.
Right.
That is extreme ultraviolet lithography machines that cost hundreds of millions of dollars each.
So it's locked in.
When a manufacturing company commits that kind of massive capital, they have visibility into demand that goes out years.
They aren't guessing.
They have firm orders from their clients.
There was a great moment on their call with the TSMC CEO, C-Wei.
Yeah, I loved this part.
He addressed the AI bubble fears directly.
He did. He actually admitted he was nervous.
Which you never hear from a CEO.
Right. He said I was very nervous about a bubble. Which is just refreshing honesty.
Most CEOs just tell you everything is up and to the right forever, don't worry about it.
Exactly. It felt very human.
But then he said he went and talked to all his customers.
Right. The hyperscalers, the auto companies, the device makers.
Everyone buying chips.
Yes.
Yeah.
He looked at their specific roadmaps. And his conclusion after all those meetings was simple.
AI's real.
AI is real.
He sees it growing into daily life everywhere.
It's not just sitting in data centers anymore.
Right.
It's moving to edge devices.
Yeah.
It's in our phones. It's in our cars. TSMC sees sustained massive demand through 2029.
So if you as an investor are worried this is a bubble like 1999 or 2000,
Right.
the guy building the physical infrastructure says, I'm putting $54 billion on the table that says it's not a bubble.
Exactly. You know, in the dot-com bubble, we were building infrastructure for traffic that didn't exist yet.
Right, the dark fiber we talked about.
We laid fiber for users who weren't even online yet. But in this AI boom, the demand is already outstripping supply.
The traffic is already there waiting for the highway to be built.
Precisely.
Okay, so the tech story is incredibly bullish, albeit shifting and getting a lot more competitive.
Yes.
But we don't live in a tech vacuum.
No, we do not.
We live in a world with taxes and wars and interest rates.
The messy real world.
Exactly. Which brings us to segment 5, the macro storm.
This is where things get really choppy. This is the wet blanket on the tech fire.
Because while tech is battling it out for the future, the broader market is getting really defensive.
Very, very defensive.
We saw a massive shift to safety this week.
We did.
The U.S. 10-year Treasury yield fell to around 4.03%.
Which is a 3-month low.
For the listener who doesn't track the bond market every single day, what does that mean?
When yields fall, it means the actual price of bonds is going up.
Because people are buying them.
Right. And when people rush to buy U.S. government bonds, which are considered basically the safest asset on the planet,
Yeah.
it means they are scared. They want a safe place to park their money because they are worried about economic stability.
What exactly are they worried about right now?
2 big things driving this right now: tariffs and geopolitics.
Let's start with the tariffs.
Yeah.
We have President Trump's trade policy.
Right.
There was a lot of noise about a threat of 15% tariffs under Section 122.
Which is an emergency economic power.
Right.
It allows the president to impose tariffs quickly in response to an quote-unquote extraordinary threat to the national economy.
But the past level, the actual level is 10%, right?
Yes. So there's this massive confusion. Is it 10? Is it 15?
And markets absolutely hate confusion.
More than anything, markets can handle bad news. They can price in bad news. They
Right.
cannot price in uncertainty.
Because if you are a global company,
How do you price your goods if you don't know what the import tax will be next month?
you can't.
You literally can't. That uncertainty makes investors extremely risk-averse. They pull money out of volatile growth stocks and they put it right into treasuries.
And then there's the geopolitical side. Iran.
Yes. The U.S. delegation just started nuclear talks with Tehran in Geneva.
Which is always a tense situation.
Whenever you have high-level nuclear negotiations involving the U.S. and Iran, the geopolitical risk premium goes way up.
The fear index spikes.
Yes.
And that drives gold buying too, doesn't it?
Exactly. Gold and bonds. It is the classic, the world is scary portfolio.
Safe havens.
Right?
And then locally, we have the labor market to look at.
This is critical.
Because we talked about AI replacing jobs in theory with the SaaS apocalypse.
Yeah.
But let's look at the actual macro data. Initial jobless claims rose this week to 212,000.
And it was expected to be lower, closer to 208,000.
Right, so it's a slight rise,
It's not a crash by any means. 212,000 is still historically a very decent number.
but the trend is softening.
Yes, the labor market is softening.
And the market's interpretation of this softening is really interesting regarding the Federal Reserve.
Yes, because a softening labor market usually means the Fed can start to cut rates to help stimulate the economy.
Right.
But because inflation is still a bit sticky right now,
Yeah.
and there is so much fiscal spending going on with the tariffs and the massive AI build-out,
What are traders doing?
traders are actually pushing the expectation for the first rate cut back to July.
So we are stuck in this higher for longer environment.
Exactly.
But the underlying economy is starting to creak just a little bit under the weight of those rates.
It's a very delicate balance. The Fed needs the labor market to cool down enough to kill inflation entirely.
But they don't want it to freeze completely and cause a recession.
They are trying to land the plane in a hurricane right now.
Okay, we have covered a lot of ground today.
A ton.
We've got the chip wars. We've got AI agents destroying seat-based software models. We've got macro fears. Let's move to segment 6, synthesis.
Let's tie it all together.
Because I look at the SaaS apocalypse, this idea of software directly replacing human labor.
Right.
And then I look at the macro labor data, showing jobless claims rising slightly. Are we seeing the first actual data points of AI impacting employment? Or is it just too early to say that?
I think it's the very early tremors.
Tremors.
Look, companies like Rakuten and Salesforce, they aren't deploying these AI agents just to be cool or trendy.
Yeah.
They're doing it to be efficient. And in corporate America, efficiency usually means doing more work with fewer people.
Headcount reduction.
Yes, we are definitely seeing a rotation in the economy.
A rotation of capital and labor.
Exactly. Capital is rotating out of old software models, the seat sellers.
Right.
And it's moving into the new hardware and the agent models. We saw that with the NVIDIA sell-off, too.
How so?
Investors are taking profits from the big winner of 2024 and 2025.
NVIDIA.
And they are actively looking for the winner of 2027.
And where's that money going right now?
It's going into agentic AI. It's going into defensive bonds because of the macro risks.
And it's going into gold.
Yes.
The gold and silver rotation was mentioned in the sources, too. It's holding very steady or rising as a hedge.
Which makes perfect sense, right? If you are worried about sovereign AI wars and unpredictable tariffs and massive national debt, gold is a historical hedge against the system itself.
And connecting the chip.
Yeah.
Spend that massive $54 billion from TSMC, the NVIDIA, clusters the $100 billion Meta AMD deal.
Right.
Connecting all of that to the sovereign AI narrative.
Right.
It really feels like compute power is becoming the new oil.
It truly is. Nations and megacorporations are stockpiling it.
Stockpiling GPUs.
They are treating it as a strategic national reserve.
Because if you don't have it, you're left behind?
If you don't have compute, you frankly don't have a future economy. That is the fundamental belief driving all this spending.
It's not just about chatbots anymore.
No, it is not about will people use chatbots to write emails. It is about will our nation be globally competitive in the 21st century.
That's a really heavy realization. It's about national competitiveness.
Correct.
So as we wrap up this deep dive, let's summarize the key takeaways for the listener.
Sure, let's do it. Number 1, NVIDIA is still king, but the crown is getting heavy.
Very heavy.
The market demands absolute perfection from them, and they are pivoting hard to inference to prove that the ROI is real right now.
Got it. Takeaway 2.
Meta and AMD are officially the resistance.
Right.
A $100 billion deal creates a very real structural alternative in the hardware market.
Takeaway 3. Seats are out, agents are in.
Yes. Salesforce and Anthropic are proving that the fundamental unit of software value is shifting from the human user to the AI agent.
And finally, takeaway 4. The real economy is shaky.
Very. Tariffs, labor softening, and geopolitics like the U.S.-Iran talks are providing a very nervous backdrop for this entire tech revolution.
It's an incredibly volatile mix.
It is.
And I want to leave the listener with a final thought today, a somewhat provocative one based on everything we've discussed.
Go for it.
We talked about Rakuten closing engineering tickets with AI. We talked about agents doing the actual work of junior employees. It raises a very uncomfortable question for the labor market.
It really does.
If AI agents are starting to close engineering tickets, draft legal summaries, manage workflows better and faster than junior human employees, and companies are rapidly shifting to outcome-based pricing.
What happens to the entry-level job market in 2027?
Exactly.
What happens?
It's the junior associate problem. Think about a big law firm or a coding shop.
Right.
Historically, the unspoken deal was you hire juniors fresh out of school.
You pay them a salary.
You actually lose money on them for the first 2 years
Yeah.
while they learn the ropes and make mistakes.
Right. You are investing in their potential.
And then eventually they become profitable senior employees.
But if the AI already knows the job.
If the software is already functioning as a senior level coder right out of the box,
Yeah.
why do you hire the learner? Why do you as a company pay for that apprenticeship phase? You don't.
Wait.
But then if you don't hire the learner, where do the human seniors come from in 10 years?
Exactly. If you completely cut off the bottom rung of the corporate ladder, how does anyone ever climb it?
Are we literally looking at a future where you don't get hired to learn the job because the software already knows it?
That is the massive structural shift that society hasn't figured out yet. And judging by these tech earnings reports,
It's happening fast.
it's happening much faster than we planned for.
That is definitely something to chew on over the weekend. For everyone listening, look at your own industry. Look at the junior tasks around your office.
Yeah.
Are they ripe for automation? Because the technology isn't coming anymore.
No,
It's here.
it's definitely here.
Thanks for listening to this deep dive.